Well, Paul, it's official. I've watched every show on Netflix. It's all over. I fire it up and I can't find anything anymore.
You know, I hope Netflix has the data on like which user has the most watch time on their account.
I don't watch that. I'm kidding, but I just haven't found shows that I'm in love with. I give up on some shows. I mean, I watch about 20 minutes of TV before I go to bed, Mo. That's about it with my wife.
I started Friday Night Lights again last night.
It's a great show.
Mm-hmm.
Kelly.
But we love Netflix. Everyone loves Netflix. You know this. But what about the stock price, Paul? We have this company that's chugging along, doing great, and we have a stock price. We want you guys at home to separate these two entities and figure out, is the stock price justified by what the company's doing financially? We will find out now using our beautiful 8 pillars. Paul, go ahead.
Awesome. So first off, guys, follow us on Instagram. You'll see more about our personal life as opposed to all business. But Netflix, more like... That was for Matt, my good friend, our good friend. Okay, so Netflix is a major hype stock. I love Netflix. I have a subscription myself. Everybody has a subscription. You sit there and go, man, I pay, $14 a month for thousands of videos and TV shows. I mean, I don't even have cable. Do you know that?
I just got cable back so I can watch football. But
I have a Hulu TV only so I can watch sports.
Yes.
That's it. Netflix. $260 billion company.
Jeez.
Look at this 5-year PE, 136. We want it to be less than 22.5, so that's an X.
Oh my gosh.
I'm actually surprised about this gross margin. I would have thought it'd been much higher, but maybe they spent a lot of money trying to get new users. So, guys, this return on invested capital is very low. Their free cash flow is very low. I wouldn't necessarily hold that against them. They probably spent a lot of money producing more shows, buying more rights to I don't know what the capital expenditures, et cetera, but I'm not as worried about the return on invested capital.
What Paul's going to do is go through our 8-pillar analysis, looking at the financials, the 8 pillars of buying a stock. We'll head over to Trader Mo to see if people are trading Netflix at a more quicker pace. Paul, get back to revenue growth, which is pillar number 3.
So yeah, the first 2 pillars were an X because we want return on invested capital being greater than 9%. Is this shocking to you, Seth? 10 billion to 27.6 billion? That should not be shocking. This company's growing like a mug.
Pillar number 4 is profit growth. What's a mug?
I have no idea. It's probably something offensive, so you might want to bleep that out.
Okay, go ahead.
360 million to 4.4 billion. Huge growth. Huge growth over the last 5 years. Now, shares outstanding. I'm actually surprised it's not this bad. 431 million to 443 million. So that's still an X here. Now, guys, for those of you who don't look at this is the silent killer of stocks. Now, this company is very expensive, so you should be okay with them issuing shares rather than debt. But if you own the stock, look at back here in 2012, 388 million shares versus 443. They've diluted you along the way. They've increased the number of shares without giving you more shares. So now they're splitting the revenue and profit up in more ways, and that's not good for you. For example, let's say you're the company, let's say you personally invested in a very small company to make it simple. And that company had 10 shares outstanding and it made $10, and you owned 1 share. You're going to get $1 of that profit, right? $10 divided by 10 shares. Let's say all of a sudden they increase to 12 shares and they still make $10. Now you're getting 83 cents of every profit instead of $1. You still own the 1 share, but now it's out of 12. That's why dilution hurts you. It hurts the people who bought early because it dilutes them out of other earnings and revenue. This is not something that's, you must ignore it or you must adhere to it, but just keep it in mind as companies are growing and you're looking at companies.
If you've been yearning for this approach of looking at the financials behind a company and you have never had the data, you're in luck. You can get the software that Paul is using behind him right now and finally grasp what a stock price is and what it means, the content behind it.
But wait, there's more.
Go ahead, Paul.
Guys, here's what you get. The mobile app has the entire software on there. 8 pillars, 30 years of financial data, stock analyzer tool. Look at all this exclusive daily content. Biggest thing here, Discord community, over 5,500 people who pay for the software, who talk in Discord in a very organized way. All of this, 87 cents a day. 87 cents a day. That's less than a cup of coffee versus our competitors at $1.99, $1.99 and 35, and they don't even give you everything we give you. No brainer. Is 87 cents a day worth it for you to understand your financials and to make more money in the long run? If the answer is no, what are you doing?
Click the link below. Go to everythingmoney.com to join our community, or Patreon. They both lead you to the same place to get our Discord access and the software. Go ahead, Paul. Go get back to pillar number 6.
So pillar number 6 is about long-term debt. we want to take their average 5-year free cash flow. In this situation, unfortunately, if you look at the main page, their 5-year average free cash flow is a negative number. So this is going to be an X automatically. Usually what we want to do is we want to take their total long-term liabilities divided by their 5-year average free cash flow and be under 5. What that means is if they average the same 5 years of free cash flow, they can pay off all of their debt in 5 years. That's what we want to look for. In this situation, unfortunately, it's a negative number. Then we go to our cash flow statement to see it. The great news is they went from negative $2 billion to a $1.4 billion. But guys, look, over the last 10 years, they've had negative cash flow all along the way.
What does this mean as a normal person trying to get a grasp on these numbers, Paul? How do they have negative cash flow? What is it? What are they doing?
So guys, what they're doing is negative cash flow is cash from operations less your capital expenditures. If you look right here, they're probably spending a lot of money here trying to gain users, and that was their operating cash flow. So their capital expenditures are their investments back into their fixed assets. I wouldn't worry about this as much, and we're going to use a stock analyzer tool to understand this. I wouldn't worry about this as much because this is a growing company that's trying to get market share and really dominate the market share. There's a lot more streaming services coming out now. I think in the next 5 or 10 years, there'll be a lot more consolidation because everybody has streaming. I mean, I think Seth, you have your streaming services alone for your Seth and Beth website.
It's just me stroking my beard all day long.
And people pay $74 a month to watch and do that.
Just under the bid and ask price, Paul.
Yeah. So cash flow is what I look at most importantly. It's the money in, money out. It's tough here, but I wouldn't worry as much about that. Let's go make some assumptions in our stock analyzer tool after Mo's done to determine what we should pay for the company.
Most of our people trading this in the bid and ask nation.
So this is a good stock to always trade. So if somebody caught this little sweet spot reversal and run up, take your profits right now because I'm seeing a lot of these wicks on these candles. You see that, Seth?
Yes.
So these wicks that are just happening. So these are tweezer patterns. So basically you have what looks like a tweezer on top of your candlesticks. And anytime you see a tweezer pattern like that, the two tweezers.
Run for the hills.
Yeah, take your profits and sell because you're gonna get a reversal, a stock price reversal, and that's exactly what's happening right now. So I'm not saying it's over, but with this stochastic kind of rolling over, you're kind of dipping down here, this trend might be over. Now, what I would do is because that trend is rolling over, I would actively catch that. Go to a daily chart, you're coming down perfectly. When you get an engulfing candlestick, run this thing down to the 25-day moving average, and you can just do a quick 2-3 day swing trade on this, probably make 1%, 3%, 4%, 5%, and you will be very happy with that. But that just shows you how the overall trend right now on Netflix is higher. The daily trend is coming down. So you can be short and long. It's the same, two people, one can be long on a stock, one can be short on a stock, and it's perfectly okay, depending on what chart you're trading on.
If this interests you, join the bid and ask. You can trade with Mo on a daily basis. Paul, you've opened up the stock analyzer tool. The final piece of the puzzle is what we should be paying for Netflix.
Puzzles.
Go ahead.
So guys, this will give you your 1, 5, and 10-year numbers. Obviously if it has it. Revenue growth is very high in Netflix. But with all the new streaming services coming out, all the competition, I'm definitely going to be cutting these numbers significantly. Share change, they're still issuing more shares, so I'm going to continue that on. Profit margin, free cash flow, even though the free cash flow is hard to determine because they haven't had it, I'm going to assume it's going to equate to profit margin along the way. PE, 14, 16, 18, significantly lower than where it is right now. And guys, this is going to be ugly. The stock's currently at 589. I mean, I have a price in the middle of 110. Oh my God, the stock's gonna fall 80%, that'll never happen. If you don't believe that'll happen, please go look at the tech bubble when companies that were this good and this awesome fell. Amazon fell from $113 to $6 a share in the tech crash. It can happen, just be patient. It's just numbers, guys. If you wanna sit here and prove how bad this is, I will assume that they do 25% revenue growth in the next 7 years, the same as their 10-year average. It's still overpriced. I still only have a number of 211. So Netflix is just massively overpriced. That's it. Any way you cut it, they're massively overpriced.
Who are the people that are buying this today, right now?
Well, people who sit there and say, I love Netflix, therefore I'm going to own Netflix.
And I think it's a lot of institutions, big money managers and stuff. They have to be in.
Yep.
They have to be in them.
Yep, they have to. Because if everybody else is in them, they got to be in them. I love my cell phone. Doesn't mean I pay $10 million for my cell phone. I still sit there and say, listen, it's not worth $10 million. It's worth $749 to me. Or whatever it is.
You know, Paul, I was one of these people buying Netflix when it was around $3 in 2009 because I had a friend said, I love this, you should buy stocks that you love. And when we started this show in 2018, I had made a huge run up and we ended up selling it. Netflix was a big
Same with
chunk.
Carl Icahn. He did the same thing. He was it Carl Icahn? I don't remember what it was, but he bought Netflix like 40 and it went to like 300 and he was just like, listen, I'm taking money off the table.
But in essence, I had no process. I was just hoping Netflix would go up.
Well, and your thought was, well, Netflix is growing, therefore the stock's going to grow. Not necessarily.
Yes, not necessarily. So
Not necessarily. Look at Intel, Cisco. Back in 2000, they haven't hit their 2000 stock price yet, and the companies have tripled in size and tripled in profit. Just if anybody is arguing about it, I'll say go to Intel and Cisco. Their profit and revenue have tripled, and their stock is still lower than it was in 2000. Now there are other companies who've done better, like Amazon, Microsoft, etc. But their profit and revenue went sky high, and I still think they're overpriced today.
in the end, as an investor, as Warren Buffett says, you get a punch card of 20 great buys in your lifetime. We're trying to find those in the weeds, those needle in a haystack type stocks where you can buy really low, buy a really great company really low. And Netflix is a great company, just not really low at the moment. So.
Yep, I use Netflix not every day, but every week. So thanks very much, guys. Follow us on Instagram and
Fondle thumbs up on the way out. We'll see you on our community. Love you guys.